They told you it was a market correction. They told you it was just profit taking after a record-breaking rally. But if you look at the data coming out of the exchanges today, Monday, February 16th, 2026, you'll see that the 10% crash we just witnessed wasn't an accident. It was a coordinated strike. While the mainstream media points to the whoosh shock and the sudden hawkish pivot of the Federal Reserve, the real story is hidden in the leaked inventory numbers and the massive disconnect between the paper price in New York and the physical price in Shanghai. Today, we are pulling back the curtain on why silver was intentionally slammed, who stood to gain from the $75 floor, and why the silver you hold in your hand is becoming the most dangerous asset in the global financial system. To understand the 10% plunge that shook the market on February 12th, you have to look at the state of the silver market leading up to that moment. We entered 2026 with silver in a vertical moonshot. In January alone, the metal surged over 60%, screaming past the $50 psychological barrier, then $70, and eventually touching an intraday high of $121. The world was waking up to the fact that the silver deficit isn't just a theory anymore, it's a physical reality. We are currently in our 6th consecutive year of a structural silver deficit. The Silver Institute is projecting a 67 million ounce shortfall for this year alone, adding to a total deficit of over 800 million ounces since 2021. The world is literally running out of silver at the exact moment that AI data centers, 5G infrastructure, and the global solar push are demanding more of it than at any point in human history. So, why did the price suddenly collapse? It started with what insiders are calling the Warsh shock. The nomination of Kevin Warsh as the next Federal Reserve Chair sent a lightning bolt through the precious metals market. For 2 years, the market had been betting on a dovish pivot, the idea that the Fed would have to print money and cut rates to keep the debt-laden U.S. economy from imploding. Warsh, known as a hardline inflation hawk, represented the opposite. His nomination signaled that the easy money era was over and that the U.S. dollar was going to be defended at all costs. Almost overnight, the dollar index, DXY, surged, and bond yields jumped to 4.3%. For the algorithmic trading bots that control the COMEX, this was the signal to dump. But this is where the official story ends and the manipulation begins. At the exact moment silver was facing macro pressure from the dollar, the CME group took the aggressive step of raising margin requirements for silver from 11% to 15%. This is a classic move often seen when the big shorts are in trouble. By raising the cost to hold a position, they forced every leveraged retail trader and small hedge fund to either come up with millions in cash or sell their positions immediately. This triggered a stop-loss cascade. As the price dropped, more margin calls were triggered, which led to more selling, creating a self-fulfilling prophecy of a market crash. In a single day, over 1 billion ounces of paper, silver, more than a year's worth of global mine production, was dumped onto the market in a matter of hours. The proof that this was a paper market execution lies in the physical premiums. While the COMEX spot price was being hammered down to $75, the real-world price to actually get your hands on a silver bar remained stubbornly high. In fact, a leaked internal memo from the Shanghai Futures Exchange, SHFE, reveals that while the West was selling, the East was buying the dip with a ferocity we've never seen. The premium for silver in Shanghai versus New York hit a record high during the crash. China isn't just buying silver, they are vacuuming it out of Western vaults. Inventory levels at the Shanghai Exchange have plunged to their lowest levels in a decade, down to nearly 300 tons. At the current drain rate, China's exchange vaults could be functionally empty by the end of April. What the big banks don't want you to know is that this 10% drop was a liquidity flush. They needed to shake the weak hands out of the market because silver was becoming untradeable on the upside. When silver hits $120, it breaks the industrial complex. It makes solar panels too expensive to produce and threatens the profit margins of the tech giants building the AI revolution. By crashing the price back to the $70, $80 range, the institutional shorts were able to close out their losing positions and reset the market. They used your panic as their exit liquidity. Now, let's look at the direction the market is moving toward next. Today, February 16th, we are seeing silver stabilize around $77.43. To the casual observer, it looks like the rally is dead. But to the sound money crowd, this is the most bullish setup in history. We are seeing a shift from panic selling to rotational accumulation. The weak leverage has been wiped out, and the silver is now moving from the hands of speculators into the vaults of long-term strategic players. Technically, the $71 to $80 zone has now become a structural demand corridor. This is where the big money is quietly buying. If silver can reclaim the $80 level and hold it through the end of February, the bearish trend is officially invalidated. Analysts from major firms like Citigroup and Bank of America are already quietly revising their mid-2026 targets. While the paper price might be suppressed for a few more weeks, the physical reality is that there isn't enough silver to satisfy the demand from the AI and green energy sectors. What happens next? We are entering the delivery phase. As the March contracts on the COMEX approach their expiration, we are going to see if the banks actually have the silver they've promised to deliver. If the drain in Shanghai continues at this pace, and Western inventories at the COMEX and LBMA continue to slide, we are looking at a force majeure event. This is when the exchange admits they don't have the metal and offers to settle your contract in cash instead of silver. That is the moment the paper price becomes a fiction, and the physical price goes into the hundreds, if not thousands of dollars. The direction for silver is clear. The path of least resistance is up, but the ride will be violent. The powers that be cannot allow a free market in silver because silver is the ultimate tell on the health of the US dollar. When silver rockets, it tells the world that the dollar is dying. By orchestrating a 10% crash, they've bought themselves a little more time, but they haven't solved the supply problem. You can print dollars, but you cannot print silver. As we look toward the rest of 2026, the $150, $170 bull case scenario is still very much on the table. The war shock has stabilized the dollar for now, but the U.S. national debt is still growing by $1 trillion every 100 days. Eventually, the Fed will be forced to choose between saving the dollar and saving the banking system. When that choice has to be made, they will choose the banks every single time, and that is when the great debasement begins in earnest. For the silver holder, the message is simple. Don't be distracted by the screen price. The leak is out. The vaults are emptying, the manipulation is being exposed in real time by the Shanghai premiums, and the 10% drop was nothing more than a gift for those who understand the true value of sound money. We are moving toward a world where the physical metal is the only thing that matters. The paper trap has closed, and those who held through the crash are the ones who will own the future. Watch the $85 resistance level closely. A breakout there isn't just a price move, it's the end of the old financial regime. Stay grounded, stay physical, and don't let them steal your seat at the table right before the main event.